you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Welcome back to Stop Doing What You Hate, How to Win the Retirement Game. I'm your host, Harold Green of Bright Tree Wealth Management, and this is episode 6 of our ongoing series, Financial Advice versus Financial Propaganda. And over the last few episodes, we've talked about Wall Street's incentives structure, and we talked about the myths that refuse to die in retirement planning and how outdated rules quietly sabotage long-term financial security. And today, we're going to talk about something just as powerful and often more dangerous than Wall Street itself, and it's the financial media. This is where I spend a lot of time thinking through what I'm going to say to my clients about the situation, because I cannot make them turn off their TVs. I can't make them turn off their radios. I can't make them turn off the things that people say to them that just kind of gets me a little bit besides myself. And I have to calm myself down and just think I'm human too. I hear stuff all the time. I hear people say stuff, and I'm not immune to hearing it. But what I have learned how to do is I've learned how to lock it down, lock it out, and keep it moving. Because even if Wall Street creates the narratives, it's the financial media it's what amplifies them, and it repeats them, and it embeds them into your everyday thinking. And, for retirees or anybody approaching retirement or anybody that's trying to build wealth, this influence can quietly shape behavior in ways that permanently damages your outcome. And that's not good. So today's episode is about learning how to see through the headlines, understanding business models for the financial media, and how to protect your retirement plan from emotional whiplash. And because this is an investment show, all investments do carry risk of loss, and past performance is no indicator of future results. You got to understand your time horizons, your risk tolerance, and and got to do your due diligence and make sure you're investing according to a well-balanced financial plan and it has to be comprehensive. And you don't change it based on what the media say. So are you ready? 1, 2, 3, let's get it. No, I have an outline of what I want to talk about. And I may stick with my outline, and I may just jump off script and do some other crazy stuff and talk about some other crazy stuff. But I'm starting to be more disciplined about what I want to say, because I've thought about a lot of this stuff, and I've built a system to help people avoid it. But I'm going to start in these different parts. And the first thing I want to talk about is how financial media is not education. And it's almost like indoctrination. And I want to start with a hard truth. The financial media is not designed to educate you. That's for real. A lot of it is not designed to educate you. It's designed to capture and hold your attention, because just like social media, news outlets, they live and they die by clicks, views, time spent watching, ad impressions. And the interesting thing is calm, boring, disciplined investing does not drive engagement, but fear does. And urgency, it drives it. Excitement, it drives it. And bold predictions do. You ever watch travel commercials and how captivating they are? And it just makes you want to get up and call your travel agent and book your ticket to that place, even though when you calm down and think about it, you really have no interest in going there. And that's why headlines are written and they're written the way they are. Like markets plunge on inflation fears, investors panic as stocks slide, this stock could double, or Wall Street braces for a crash. Is this the start of a new bull market? Or Warren Buffett just sold all of such and such stock, and now he's doing this. These headlines are they're not neutral. They're engineered. They're manufactured. And they're written to trigger an emotional response, because emotion keeps you watching. And the longer you watch, the more valuable you are to the advertisers. And it doesn't make financial media evil, because it's a business model. Is it a fair one? Because, I would say basically only 3% of the people in the United States can retire with enough to last them their entire lives. I think this is a big issue. Now, we're going to dig into that in a second. But when retirees mistake entertainment for guidance, the consequences can be severe. And the next thing I want to talk about is why TV experts they're always confident. You know, they're always confident, right? They're not financial chumps. They're like financial champs. The way they come on, like out the gate, like Muhammad Ali, I'm the baddest man that ever lived. I'm the greatest of all time. I'm the best investment advisor ever. I never get it wrong. And you'll have like the host saying, "Yeah, man, you've been right all the time. Every time you've been right all along." And have you ever noticed something about that? I mean, they're bold, confident, courageous, and full of faith, is what I say. And they speak in absolutes. This is where the market is headed, and this sector is the place to be. You don't want to miss this opportunity. Now, I got to give some of these guys credit because I watched a lot of them, and you know what? Some of them are really good, and we do a lot of research and we read up on stuff, and some of these guys are really good. But you got to be able to know how to separate it all out. But here's what you rarely see: follow ups on wrong predictions. So get him back on. It was wrong. Get him back on. Yo, Johnny, you were wrong on this stock, man. You were really wrong. What happened? Accountability for bad calls, long term scorecards. That's why we look at the analyst reports, whoever we follow, and we do our own analysis, but we also look at other people too, much larger firms. Okay. Discussions on sequence of risk returns, how that's hurting that person who bought that stock. Now they got to pull 100 grand out, and now they're down 30% because they made bad picks. Conversations about retiree specific danger. We don't talk about that. And I talk a lot about that in my shows where, people are say, pay your house off and don't have any debt on the house. And you're in an area where, you've been so focused on paying off a house that you haven't built any wealth to generate income to help offset the taxes. And you end up losing the house because you can't afford the taxes because you're in a fixed bucket. Why is that? Because confidence is entertaining. Humility is not. A strategist who says, I don't know, doesn't get invited back. I don't know. I mean, you can't be on there. You got to be having bold picks. A strategist who says, here's exactly what will happen next becomes a regular guest, especially if they're right. Now, if that host doesn't want to lose credibility, they can't be having the wrong people back on. They got to have people on that are telling the truth all the time. And a lot of times I'll watch some of these shows and some of the guys will get real political and they'll get caught on the carpet saying, hey, are you saying this because of politics or are you serious about this? I like that when they call them out because you have to be neutral. And the incentive structure rewards certainly not accuracy. And this is critical for retirees to understand. Very critical. Financial media rewards people for being interesting, not for being right. That distinction alone explains a huge amount of bad investor behavior. Like, I'll have clients who tell me, Harold, I love listening to your show because you really keep us informed. You let us know what's going on. And the truth about it is, whatever I'm saying to you in a podcast show, if you're a client, it better be happening in your portfolios. Otherwise, I'm a fraud. And that's why people keep referring people into me because whatever they see going on their portfolios is exactly what I talk about in my podcast shows and exactly what they see on TV. I'm saying the truth. And the next thing I want to get into is why retirees are hit hardest because of this media thing. And it's the media driven behavior that affects everybody. But retirees are hit the hardest. And here's why. Retirees are closer to taking out money than ever. Like, they're closer to taking out money. They're more emotionally sensitive to losses, And they're more focused on stability and less able to wait it out. And they're more vulnerable to sequence of return risk. And, I had a client, I got an email and they were sharing some things to me about, how they're getting nervous and stuff. And it's like their portfolio was down kind of big. And when I had looked at it, and I was like, okay, they're up like 100%. Like in the last 3 years, we've like double, tripled their money, and they're down some. And I'm like, okay. It bothered me a little bit because we've had this conversation probably like 5 or 6 times in the past. Like we had it a lot. So I saw them. When I saw them, I said, let's talk about this thing that you got going on. What's bothering you? Why are you telling me this? And they said, because, I was having lunch or something with some friends and they were like, man, they were telling me all this crazy stuff about their advisor and stuff and da da da. And it's like, I'm like, what the hell does that got to do with me? What does that got to do with me? We're doing something totally different than what those guys over there are doing. And I said, you know what we're up to. I said, you know what we do. You know how it works. And he's like, yeah, but I was just getting nervous. And I said, yeah, I get it. And I said, most likely you're never going to need all of this money in your lifetime. It's going to go to your kids anyway. Why are you tripping? And it's like, yeah, but my friends, look, a scary headline for a 35-year-old is an inconvenience. A scary headline for a 65-year-old can trigger panic selling. This is crazy. And once panic selling, it happens in retirement, the damage can be permanent. And this is why financial media noise is not just annoying for retirees, it's really dangerous. And it's why learning how to filter, limit, and neutralize media influence is a retirement survival skill you need. Like I said, you lock in and you keep it moving. And the next thing I want to talk about is I want to talk about headline engineering, words that moves markets. And I want to talk about the language because language is the primary weapon of financial media. It's words like plunge, crash, collapse, surge, soar, meltdown, rout, panic. These words are chosen very deliberately. They're not there to describe the reality in a real accurate way. They're there to promote and provoke emotion. Here's what people don't realize. The majority of market crashes reported in headlines are normal volatility. Like a 1 to 2% daily move in the stock market is common. A 5%, 5 to 10% pullback, it happens almost every year. A 10 to 15% correction happens on the norm. But when headlines frame these moves as panic or collapse, the emotional impact far exceeds the financial reality. It's just fake news. And for retirees, this matters a lot because when the withdrawals are happening, emotion it changes behavior, and it's like, oh man, I'm pulling money out of this bucket, and now I see this thing go down. Maybe I got to postpone that trip. I've heard people say that, Harold, I got to put the trip off. I got to put the trip off. And it's like, are you kidding me? You got so much money, you're never going to need all of it. I mean, you're only going to need some of it. Why are you tripping? And it was an emotional issue. Some clients told me they were called stupid for doing what they do. And okay, I want to talk about the volatility illusion, like the volatility hoax. Financial media, they often present volatility as danger, but volatility, it's not danger by itself. Volatility is simple movement. And the real danger in retirement isn't volatility. It's being forced to sell during volatility. But yet the media is not going to tell you stuff like that. You're going to hear stuff like markets becoming unstable, investors are on edge, uncertainty is rising. And the language just creates the illusion that something is fundamentally broken, even when the markets are behaving exactly as expected. So that's why we have to do fundamental analysis. And what I tell clients is, look, when we're doing our fundamental FA, we look at it, we look at CNN fear greed, and we say, okay, is anything wrong with the fundamentals of the stock? No. What's wrong? It's the trend. It's the emotional propaganda that's being spewed out there. And sentiment is now sour, right? Like Nvidia, the sentiment is sour. They're selling it because they're soured on it because AI is taking away people's jobs and stuff like that. It's like people saying stuff like that it has nothing to do with them. Like you're always going to have a job if you're on TV, unless you're just sorry, you know what you're doing. AI is not going to take your job. I mean, there's guardrails in place. But again, media turns normal market behavior into it's everything is a crisis. And it's the emotional crisis that will lead a retired person to reduce the risk at the wrong time, sell after losses, chase safer narratives, rotate into yesterday's winners, and abandon their long-term plans. And this is how media noise converts volatility into permanent damage. And one of the most harmful habits retirees develop is watching the market every day. And daily market coverage creates three problems. Number one, it exaggerates importance. Sorry, but most daily market moves have zero long-term significance, like just zero. It invites constant decision making, and the retirement plan should be reviewed every quarter or semi-annually, not daily. And it also keeps your emotions elevated, like fear and excitement, both. They degrade judgment, and your blood pressure goes up, your cholesterol goes up. You don't go to the gym like you're supposed to. Now you're worried. And financial media, they thrive on daily updates because daily drama increases engagement increases ad revenue, and calm viewers, they just tune out. Like, I'm hearing this garbage again. I don't need that. But retirees don't need daily information. They need periodic clarity, like, the hand holding, not every day though. And I don't want to say this, but I'm gonna have to. I have a friend who's a neuropsychiatrist, and one of the things we talk about is how emotional people are when it comes to money. And it normally stems from something else that's going on in their lives. And I always tell clients, like, if this is bothering you that much, it's hard for me to say this because I don't want to sound cruel and uncaring. It's like if you retire and you don't have enough for retirement and you need to take the risk, otherwise you're going to be working at Walmart for like the next 20 years, even though you shouldn't be, you might want to go get some psychological counseling and find out why you are becoming risk averse when it's really not necessary. That's very important. And here's the mentor voice coming through clearly. If you watching the market every day in retirement, you're almost guaranteed to make a bad decision eventually, not because you're responsible, but because the system is designed to wear you down emotionally. It's insane. And you might think, well, I watch balanced financial news. Here's the problem. Balanced reporting still requires constant updates, fresh opinions, opposing viewpoints, and urgency, which means even balance shows they still create emotional noise. They may present both sides, but they still demand attention. That's all it is. And attention is the currency, right? That moves it. Balance doesn't mean calm. Balance doesn't mean useful. Balance doesn't mean appropriate for retirees. Retirees don't need debates. They don't need predictions. They don't need expert panels. They don't need hot takes. They need structure. They need rules. They need discipline and emotional insulation, right? We call it putting the blinders on. And the next thing I want to talk about is how the algorithm is not your friend. And in previous generations in retirement planning, this stuff didn't exist. 15 years ago, we didn't have algorithms for the most part driving things. Social media platforms, video platforms, and news feeds are not neutral. They're designed to maximize the one thing that they need. It's the currency mover. It's the engagement. And the engagement is driven by like outrage, fear, excitement, certainty, extreme opinions, and calm, nuanced, disciplined financial advice doesn't spread well online. But the bold predictions do. And the fear-based warnings do. Everything is about to crash. So will 10x. Algorithms, I mean, they just keep you watching and different things like that. And this is dangerous because here's what happens. The algorithms pick up on news and they pick up on media and they'll either buy or sell. And if they sell, they're selling to a point. They're selling to a percentage, either up, they're buying to a percentage or selling to a percentage. If it goes this much up, buy. If it goes this much, like goes down this much, sell. And then it'll sell, and then people will wake up and they'll see it sold, and they're like, "Oh man, why is it selling? It doesn't look good. Now I'm going to sell." And then it sells again, and then the algorithm kicks back in and says, "Okay, this thing sold more. Why? Headlines, this and that. Boom." Then the algo sells more, and then it becomes a doom loop, and we have to deal with that, us as advisors, every single day. And so you gotta watch out for that kind of stuff. And when retirees are repeatedly exposed to extreme opinions, here's what happens. Anxiety increases, okay, and then judgment deteriorates. Okay, anxiety increases and then judgment deteriorates, and this is how they end up. They end up getting rid of the long-term strategy. They end up chasing narratives late, like sell and move the bonds. Like, you seen yields? Yields are spiking. When the yields go up, the value of the bonds, like your bond value goes down. Right? When yields go down, the bond value goes up. Okay. Moving in and out of markets at the wrong time, rotating based on emotion, and losing confidence in their plan. Not because they're careless, but because their environment it's engineered to destabilize them. And I want to talk about one more thing before I wrap up here in a second. And once misinformation enters the system, it feeds on itself. It's a doom loop. Okay. It all gets amplified by algorithms and it's repeated by commentators, and it becomes common knowledge, even though it's bad because it influences bad behavior. And very few people ask, is this relevant to my retirement plan? What does that got to do with me? Like, oh, Nvidia can sell chips to China. Fine, but Nvidia already said they're not counting any of Nvidia's sales to China in their profit, their bottom line. So the stock moves just based on headlines, and it's insane. And you got to ask the question: does this require any action? Does it affect any income that I have coming out of my portfolio? Look, you don't want the narrative to become the decision maker. And when narratives drive decisions in retirement, discipline collapses. You lose it. And here's why: if you're a retiree or about to retire, you need to consider how you consume financial content. It's very important. You can't consume it the same way you did when you're in your 30s and 40s because you realize you got time. In retirement, your information has to be filtered. The exposure must be limited, and then the consumption must be intentional. It can't be like you're bored and you got nothing to do, so you're going to turn on CNBC, right, or Fox, whatever business. I'm bored, I ain't got nothing to do, so I'm gonna watch TV. You're gonna make the mistakes higher. The proper way to do that is if financial content makes you feel urgency, fear, or excitement, it's probably not designed to help you. So what you want to do is you want to call up your advisor and say, "Hey, Johnny, or Susie, or whoever, you know what, this has been bothering me. Like, what do you think?" Now, if Susie or Johnny they're putting out constant content about their strategy and stuff like that, you probably don't have these questions. And a lot of times, people don't have anybody to talk to. The Bible says, "In the abundance of counselors, there's safety." And you need to have people that you talk to just to make sure that you're not running off the rails. And I want to talk to you next about how the noise destroys retirement income. And it doesn't just change how you feel, the media changes how you act. And here's what media driven behavior typically looks like for retirees. Like you sell after sharp market drop, wrong time. Moving to cash after losses, wrong time. Chasing safe assets once they're already expensive, wrong time. Buying into hype cycles late, wrong time. Reducing equity exposure near market bottoms, like because you've been worn down, like you're tired. You're tired. And when you sell in the downturn and withdraw income, you lock in losses that your portfolio never recovers from. This is not theory, it's just math. Okay. And panic selling is the silent retirement killer. And what happens is you get weeks of negative headlines, repeated warnings from experts, constant talk of crashes and recessions. All the stuff they predicted about the tariffs has not come true. And it created emotional fatigue for a lot of people. And they don't sell because they want to, they sell because they feel, here's that word, they feel like they have to. And you don't need to do that. You don't need to follow the bad advice. Okay. And also, you don't want to be chasing performance either. You want to make sure that your plan is solid. You want to make sure your plan is on track. And one of the things I want to talk about is I want to talk about headlines during bear markets and why they're especially dangerous. I mean, we had a bear market back in, I want to say 2022, after the Ukraine war started and after they drove inflation up to like 9%. I mean, I lost clients because of that, because they were like, "Harold, this is horrible. Why are you putting us in this situation? Can't you do something different? Why do we have to deal with this?" And I'm like, "Look, you're free to leave. You are free to leave. I'm telling you, we have a plan. You're on track. It's just that we have to get through this." And why is the media so dangerous? Because bear markets are slow. They're emotional. They're psychologically exhausting. It's kind of like somebody sitting on you and they don't get off. And the headlines during bear markets, they exaggerate the risk. And they keep repeating the same worst case scenarios. And they focus on daily declines. A market moved 1,000 points today and up 1,000, down 1,000. And they speculate all the time about how bad it's going to get because that's what sells. And people are sitting there. I remember like people being glued to the TV, just hearing this stuff. And it's just a steady drip of anxiety. It's like you hooked up to an IV with anxiety pumping you into your system. And when you have that anxiety, you reduce your exposure at the wrong time. You fire a good advisor that you've been with for like 15 years because you think they don't know what they're doing and everybody else is doing something different. And you just, not only you distrust your advisor, you're going to distrust the markets altogether. And you're going to go move to other kind of strategies and, you're going to move to something conservative. And then when everything turns around, you're going to be right back looking to get back in the game. Bad, bad, bad. Bear markets are temporary. And that's how you can damage it. And you're going to need a firewall. And and here's what it looks like, right? You're going to filter out your media. You got to schedule your reviews, and you got to go to trusted sources only, not propaganda machines. No daily market watching if you can help it. No reacting to headlines, and no portfolio changes based on news. Here's what I want to say about the daily market watching. This will give you a sense of hopelessness. Okay, you're not the one making the trades and somebody else, they're making the trades, and you feel out of control. You don't feel like you have things under control. And a lot of people are control freaks. They want to control everything, but this one thing, you can't control it, so you begin to feel hopeless. and helpless, and you start making bad decisions. Okay. All these decisions need to be based on cash flow, withdrawals, and just you got to have your guardrails in place. And that's why, in closing, I created the Rapid Retire financial planning process. And because it helps neutralize the media noise. And at this point in the episode, like one thing should be crystal clear to you. One thing. The problem isn't a lack of information. The problem is too much information delivered without structure. All this data, what do we do with it? My job is to consume data and package it into trades that benefit the long-term financial plan, the intermediate financial plan, and the short-term financial plan for my clients. And the financial media, they just give you more and more and more. But Rapid Retire, it gives you better. Media pushes opinions, but Rapid Retire, it installs rules. And them clients have to play by the rules. And when you're in the retirement game, if you don't play by the rules, guess what? You get disqualified. I send you to be on your own, okay? Because you're constantly breaking the rules, and I can't deal with that. I'm not changing my strategy because you don't want to play by the rules. Media, they thrive on urgency, but the thing about Rapid Retire, it thrives on patience. And I tell my clients all the time, you gotta be patient. Just sit still and be still and be quiet. Maybe meditate or something. You ain't gotta worry. We got this under control. The media, it demands reaction, but Rapid Retire, it enforces discipline. Please update your cash flow before the meeting. Please let me know if there's anything coming up. Please let me know if anything has changed. This is the core philosophical difference. When retirees retire only on information, they become reactive. But when retirees rely on structure, they become resilient. They can travel, they can live life, and they can do the things that they need to do. And here's what I want to say about the Rapid Retire financial planning process before I close this out. And it was built specifically to help protect people from emotional decision making, including decisions triggered by media noise. And here's how it does that, step by step. Number one, we have income flooring. That eliminates panic. We know where we get money from. We have an income strategy. And when your essential expenses are covered by Social Security, pensions, guaranteed income, and predictable cash flows, market headlines, they lose their power. You no longer fear downturns because your income is secure. You got money in the bag, is what they say. All right, you're good. And the next thing is the time segmented buckets prevent forced selling because we have short-term income, intermediate stability, and we have long-term growth. This means you're never forced to sell growth assets because of short-term headlines. You just don't have to do it. And your long-term money stays long-term, regardless of what the media is screaming, people. Okay. It's like me buying Apple stock and putting it in your long-term bucket when Apple was like left for dead on the side of the road. Okay. And in your long-term bucket, because we believed in which way the society was heading, personal handheld computers, it's where it was going. And people are like, no, we're going to be carrying around these big block dope dealer cell phones. No, we got rid of that stuff. And if Apple was in your long-term bucket, you're not listening to this show right now. I can guarantee you that. And if you are, you're probably doing it because you find me stupidly entertaining, which is cool. I don't care. It's all good. The next thing is liquidity buffers create emotional distance, right? Liquidity gives retirees something incredibly valuable. You got time to wait. You can wait. You can let the market recover. You can ignore the headlines and you have time to avoid panic. But without that liquidity and stuff like that, without that plan in place, every headline is going to make you feel like I got to do something about it. Rapid Retire, we use defined rules for withdrawals, rebalancing, risk adjustments, and reviews. Okay, this means decisions are made before emotions rise, right? Before panic sets in and before media noise escalates. And rules don't care about headlines. And that's exactly why they work. All right. And so I want to say thank you for allowing me to share this show with you today. Okay. And if you think that, look, I've said some things that are going to help you and you want to know more, you can call the office or log in, or not log in, but go on the website, click on the link to contact us, and just drop me a line or two saying you want to talk about this stuff, because nobody's sharing with you the things that I'm sharing with you. And you got to stop living inside the media narrative, and you got to start living inside your own strategy. And that's where true financial freedom begins. And so thanks for allowing me to share this episode with you folks. I hope that it's helping you. I'll see you in episode number 7. Until then, everybody, 1, 2, 3, let's get it.
This is thepodcastfactory.com.